Just yesterday, we saw interest rate traders. They were pinning the odds of a 50 basis point rate hike later this month at just 30%. That was obviously before Jay Powell's testimony. Now those odds, according to the CME Fed Watch tool, surging more than 70%. What does that say about what you're expecting in the markets today and beyond?
It really reveals, Frank, that no one really knows what's going to come out in the jobs report this Friday and the next inflationary data. So it's fascinating to see that surge of expectations. But what's fascinating also to remember is just last week we got so encouraged when Bostic, remember Fed Chairman Bostic came out and talked about 25 basis points. So I think the market is really getting ahead of itself. However, maybe the market got way too ahead of itself when we thought the pause was coming. So the outlier number of January, which is exactly what I thought it was for the jobs report, when we had more than 500,000 jobs, I think we're going to see a wildly different and contrasting number, weaker than expected, under 200,000 this Friday. And if we do see a revision lower in that January number, we're kind of back to where we were. And where are we, Frank? We're above the 200-day moving average in the S&P 500. The VIX is under 20. We all need to take a big, deep breath and realize that this rate normalization process, which has been going on for quite some time, is volatile, it's bumping, it's quite emotional.
All right, Ivory, what about you? Are you taking a deep breath? Are you seeing some meaning in interest rates traders going from 30% of them believing we're going to get that 50 basis point hike to now 70%?
Well, I think it's a lot like a codependent child with helicopter parents. Always somebody bailing them out. And so they're accustomed to the Fed pivoting. I don't know why they would think that. I think he was very clear in his comments that he will do whatever it takes to curb inflation. And to Jeff's point, one of the ways he wants to do that is by increasing unemployment. And I'll tell you, he's on his way. If you look at 73% of Americans who live in states where initial jobless claims have already gone up, we've already lost more tech jobs in this cycle than we did in the dot-com crisis. And so, I'd be a little bit concerned because now you're looking at bad economic data. Earnings growth on a year-over-year basis is decidedly negative. We don't just have an inverted yield curve. On a percentage basis, it's actually deeper than it was in 1981. And so when you start to bring in to play higher interest rates, that causes issues with refinancing risk. You talked about raising taxes in the federal government. That's because the Federal Reserve was sending them $100 billion a year in profits. That stopped. The refinance risk was because they borrowed so much money on the short end of the yield curve. That's going to blow a hole in the budget. So when you start raising rates, that then causes economic growth to decelerate. And so I'd be concerned, and I'd be paying close attention to how the market responds going forward.
Yeah, the decline in earnings, Ivory, is something a lot of people are watching. So let me ask you, and Jeff, I'm going to ask you the same question. How are you balancing portfolios? Just about 2 weeks ago, we've heard a lot of people say, 60-40, that'll work. Is that going to work right now, or do you want to up your investment when it comes to bonds?
Well, I'd be 40 to 60%. But look, at my age, you start to get nostalgic. I already invoked the image of Paul Volcker. And so I'd have more cash, right? Money markets are paying 4.5% to 5% with no volatility. It's not cash, it's a cash equivalent, obviously. But still, no volatility, 4.5%. That's a nice, comparison to bonds right now. Mm-hmm. Anytime people go to cash, the dollar gets stronger. So I think you're going to continue to see the dollar get stronger. And, gold typically does well when economic growth and inflation decelerate at the same time. And so those are some areas I'd want to hide in until we find out what the fallout will be from higher interest rates, because I'm concerned about the refinance risk and what that might mean for credit markets.
So, Ivory, I want to just clarify. You're saying 40% equity, 60% in mutual funds or cash?
In cash and other alternative assets like gold. And okay. If you're going to do bonds, I'd consider doing bond ladders.
All right, Jeff, what about you? I mean, I'm sure your phone's been ringing off the hook after that sell-off. How are you balancing right now? Is there any big change that you see that's needed right now?
So we are rebalancing, but I am more cautiously optimistic. But I think Ivory brings up a great point. That front end of the curve, that cost of capital with the 2-year now above 5%. That's fascinating to me due to the fact that the cost of capital, it takes time. It doesn't take a month or two. It takes quarters upon quarters. If we remember going back in the 90s, it takes decades to really have this rate normalization process. But where we're allocating, we're looking at energy. Yes, it's weak year to date, but the themes that worked in 2022 are going to work again in 2023. I have optimism that it's a post midterm election year, historically speaking, Frank, we do see the stock market up about 16%. So understand the range that we are trading in. The range in the S&P 500 is from 3,900 to 4,200. Emotions get high when we get to 3,900. Emotions get high at 4,200. I think you have to rebalance and reallocate there. But I think going into this next couple data points, remember, Fed Chairman Powell has reiterated the fact that they are data dependent. No one's really thinking that inflation can actually come down. I'm in the camp that we will see inflation abate, and there's going to be a very different picture where the Fed may be able to come up for air, sit on their hands, and let this higher cost of capital that Ivory smartly pointed out will again affect the consumer. I know it's been a mixed bag in earnings. We saw Dick's Sporting Goods yesterday rip literally the cover off the ball. But at the end of the day, I think the consumer strength will weaken going into the next quarter.
All right, you're hoping the Fed sits on their hands, but I don't think many investors are going to sit on their hands. Let's get over to picks. Ivory, your pick actually plays off the dollar. Dollar up 2.2% in just the last month. Your pick is ticker UUP. Explain why you're so bullish on this.
Well, relative to other foreign currencies, we're the cleanest shirt in the laundry bin. So as more investors go to cash, the dollar goes up. And you think about that, what that does for our global trading partners. When our dollar goes up, their currency goes down. That causes inflation, and then they have to tighten into an economy that's already slowed, and it creates another loop. So if you don't mind a K1 and waiting till very late in the tax season to file your taxes, that's a great place to hide.
All right, Jeff, we got to get over to you. Your picks, the nasties of the NASDAQ. Explain that thesis.
The nasty of the NASDAQ is very similar to the dogs of the Dow. If you think of Lucid, Tesla, AMD, these are names that really are interest rate sensitive. So I'm in the camp. I'm going back to where I cut my teeth in the fixed income pits in Chicago. I don't think the 10-year is going to be above 4%. So when that comes down, that's going to help some of the more high beta volatile names. We also like energy. We also like owning essential names. Frank, that I'm very tactical in the portfolios that I manage. So being tactical, reallocating, and buying your losers and selling your winners makes a lot of sense as we see continued volatility in a very choppy market. So take advantage of these choppy markets. Don't hide underneath your desk.